All right. What a fun intro. I love that.
Yeah.
Welcome, everyone, to the Well Sent Show. We may be some new faces if you're a regular on here, but my name's Brielle. I am a financial advisor with NFP and also one of the financial educators through WellSense. So I'm excited to be with you guys today, help answer some questions, talk about some recent news that's been out, and I'm here with my co-host Diana.
Hi, everyone. Yes, thank you so much for having us. My name is Diana Zhao. I am an NFP financial educator through WellSense, and I'm really excited to be here. And this is very thrilling. Now, it's really great that we get to do this WellSense show because WellSense is a great resource you all have available to you. It's a year-round service where you'll get comprehensive financial wellness solutions regarding any of your financial goals that you have in mind. So it's here to help you. Also, just for some housekeeping, for today's webinar, we want you to interact with us. So feel free to ask questions as we are going through the topics that we have today and what's pressing on your mind. We want to help you how we can and use our expertise to guide you. Also, for any of you out there where your employers have a survey that they do, usually like a questionnaire where they'll give you wellness points and you need like a phrase, the passphrase is just invest. Again, the passphrase is just invest. So be sure to fill out the questionnaire and get your wellness points. Now, I believe at the beginning here, we did send out a survey question or a poll question. If not, that should be probably coming up soon, asking what brought you here today? A couple of options there are retirement planning, general financial planning, market volatility, and what's been going on, or maybe something else. Maybe you just wanted to see our lovely faces today. Uh, Feel free to share those with us because we would love to get an idea of what's top of mind for you.
Awesome. Yeah, let's start throwing those topics in the chat. If not, we'll go ahead and get started. Jump into probably a big one that a lot of people have questions about today, which is recent market volatility.
Oh, yes. Yes, that's certainly a big one. Now, what we are seeing recently, that there's been a lot of ups and downs in the market, and not even like at a weekly basis. At this point, it's like a daily, hourly basis. Bill and I were talking about the market just before we started, and we already saw ups and downs just this morning. Now, of course, you're probably wondering, how does this relate to me, and how does that affect my goals? Well, when we think about market volatility, for some definition sakes, let's talk about what we're talking when we talk about the market, right? And usually we're talking about the stock market. That's where we're seeing all the craziness happen, where there are bull and bear markets. With the bull market, that occurs when the stock market and the prices, they're going to go up, and they usually use a gouge of about 20% or more, and that lasts maybe a few quarters going forward. Where the bear market, maybe what some of us are feeling right now, is when the stock market prices go down about 20%, and that lasts about 2 quarters or longer. That's probably what you're feeling a little bit of, huh?
Exactly. Thanks, Diana. Those are good definitions to make sure we understand. And with this, people, you've probably noticed that the market's being a bit jittery lately, right? Lots of ups, lots of downs, especially in the past week. Now, typically that volatility doesn't really happen without a reason. The big driver, or one of the big drivers, is this new wave of tariffs, right, that are being talked about and implemented between the US and other countries like China, Mexico, the EU, different countries of that sort. So we're seeing that these tariffs are bringing a lot of uncertainty, right?
We definitely are. And it's scary because probably for most of us, we never even heard of the word tariff. We probably have seen it somewhere, but not even thought much about it. So, what is a tariff? Well, basically speaking, a tariff occurs, or it's actually a tax that gets added on goods when they are brought into the country or imported from other countries. And they can be used to help raise revenue. However, a common side effect that we see occur is when a tariff comes into place on a specific product, that product becomes more expensive here in the US. And that doesn't feel good.
Not fun for us, right, as consumers. So when investors kind of see that those trade tensions and just talks of different trade tariffs, right, that are being added, that's when investors start to get nervous and we see that market volatility. So if you followed any sort of headlines recently, you're seeing that these tariffs are being talked about and it's really trying to be priced into the market. That's why we're seeing these large swings. You may see a lot of large swings or potentially downturns in specific sectors. For example, tech. That's a big one that we're seeing a lot of downturn because they use these global supply chains quite a bit, right? Lots of products and parts are being imported from different countries. And so we're seeing that tech sector be impacted a lot.
That's such a good point you make, right? Especially with tech, where maybe our iPhone is assembled in America, but all the parts come from elsewhere. That actually gives me a question that I want to ask you, Brielle. What should the average investor do when these markets start to get pretty choppy, like right now?
Totally. Really good question. So I see here in the chat, we also have one that's typically related to that. So they're asking, what is a good indicator? S&P 500, NASDAQ. Now, when I'm saying the market, I'm typically referring to the S&P 500, okay? That is the 500 biggest companies in the United States. Now, the tech sector, that's more the NASDAQ. So to kind of go back to what I was previously saying, that's how you kind of can separate. A good indicator, I would say, is just the total market, okay? S&P 500 is a big chunk of that. So that's a good indicator to see how this volatility is being priced in. But for the average investor, right, people like you and me, I think the first thing is don't panic. I'm sure a lot of us have logged into our retirement accounts or other accounts and have seen, like someone said, Juliana lost 10% of her net worth in just 2 weeks. Yep, we're seeing that volatility, certainly. Volatility really is a normal part of investing. These short-term swings can create a lot of uncertainty, but really our goals and a lot of things should be tailored to invest for the long term, right? And have that long-term mindset. The second thing that I'd say, right, so not panic. The second thing is to diversify. So a lot of times our equities and our stock positions are seeing a lot of these swings, but having a well-balanced portfolio, so other exposure into bonds or treasuries, other more conservative investments, is a good way to diversify. That way, you're not putting all your eggs in one basket or one company. And as we see those market swings, maybe your entire portfolio isn't taking a hit, but just a chunk of it, right?
Yeah. And I think that's such a great point that you mentioned, when, especially with diversification and not panicking. Speaking on diversification, there was a question that came in from Sabrina. Says, is now a good time to transfer from my IRA to an IRA from my 401k? What would you say?
That's a good question. I'd say now, typically the investment options inside an IRA, you're going to have more, okay? The only downside of making that transfer right now is you potentially miss out on exposure to the market. Okay, so if you transfer from a 401k to an IRA, what's going to happen is your account is going to be liquidated or put completely in cash. They'll potentially send you a check or directly deposit into your IRA. That could take anywhere from a couple days to a couple weeks. And that way you're potentially just missing out on market exposure, right? Especially in these volatile markets. I would say typically people will wait until it's a more steady, whether that's in a down market or an up market, to make those changes. But if, it makes more sense and it's more cost effective for you to switch to an IRA, absolutely. It probably depends on your specific situation, but that's one thing to keep in mind is what time are you missing out on the market? What a good question.
That's a good point that you make there. Now, continuing with diversification, because it seems like most of our answers I'm seeing here are A and B, so general financial planning
Okay.
and retirement planning. Now, there were two questions asking, one from Michelle, what about Bitcoin? And another one from Ian, what about US government bond markets?
Good question. So I'll touch on the bond markets briefly. Typically, bonds are a more conservative investment. Okay. And you'll see that those are more steady over the past many years, right? There's still going to be a little bit of fluctuation as interest rates change and, there's different volatility in the markets, but your risk is a different exposure than the market risk. So something to keep in mind. Another part of diversification, right? Not putting all your eggs in one basket. So I'd say it's good to get exposure to those bonds as well as some equities, but you're going to see different volatilities amongst both of those. So good question, Ian.
Yeah, and you know what? I'll take the Bitcoin question, right?
Yeah, there you go.
A little. Well, with cryptocurrency, Michelle, thanks for the question. It's volatile, right? There's a lot of things with cryptocurrency that it's just not regulated. So a lot of the ups and downs we're already seeing with the stock and bond market, and that's regulated. There's already craziness. We tend to see a little bit more jitters or fluctuations when it comes to crypto, just in general. So whether it's Bitcoin or any of the other ones out there. So now when you're looking at your retirement planning, since that's a lot of where the questions were coming from, in your retirement accounts or 401ks, you're probably not going to have the option for cryptocurrency there. And so if you're thinking of going into crypto, this is probably going to be a side thing. Now, if it's a side thing, then you can decide what that looks like for you. You don't want to put, just like we all said, all your eggs in one basket. You want to diversify, but because there's so much uncertainty with crypto and a lot going on that side, you definitely want to not put a good chunk of your money there just because we just don't know, right? And it's so nerve-wracking, but discipline is really important here, especially when it comes to those big goals that you have for the future.
That's awesome. We've got another good question here from Mondino. They asked, so it's about their 401k.
Mm-hmm.
If we contribute more than the company match, let's say around 15% of your gross pay, with the markets being down right now, is it a good idea to reduce the contribution to the company match only and keep the rest out of the market until it goes back up?
You and I were talking about this earlier. We talked about buying that dip. It's the nice thing about saving above your match is you're sort of like front loading your 401k and you're putting quite a bit of money in there, especially in your early years. Now, if you think about it, when you go shopping for everyday goods and services, who doesn't love to buy things on a discount? I do. I love a clearance rack. I love when I go in. Sale. Right. It says 50% off. I'm just like, thank you. I will take two, even though I may not need to. But that's sort of what you're doing right now. It may not feel like it as you see your values go down. Same with us. We looked at our accounts and not pretty. But, with your 401k, what you're doing every couple of weeks, you're buying the dip, right? So you're buying things at a lower price. So when that price starts to come back up, when we figure out everything out and the market starts, having a bull market and you're going up, you're going to enjoy that long term. So it's not a bad idea to put more in just to save for your retirement future. What would you add to that?
I think that's perfectly said. I was actually just talking to someone yesterday who was wanting to do the opposite, right? So instead of reducing their contribution, they realized this is a sale and I want to participate in it, right? So instead of contributing the 10% that they were doing, they asked for some assistance on upping it to 15. So we sat down, we upped that contribution to 15% because exactly like you said, they want to buy it while it's on sale, which right now it's fluctuating around 15 to 20% down. Mm-hmm. So that's 15 to 20% off what normally they are. So Mark kind of asked a very similar question. Do you recommend investing in stock markets while the prices are low? That's a great way to think of it, right? Now, everyone's goals are a little different. And I think, if your emergency fund maybe is lacking and you need that liquid, meaning you can pull it out at any time, maybe you do stock away a little bit more into cash or your liquid investments. That way they're not participating in too much volatility. But it really depends on your goals. If you're investing for the long term, it's a great time to buy. Even if it continues to go down, right? You're still having the opportunity to purchase that on sale. So good point.
Yeah, that's very true. So Sonja, I hope I'm saying that right, asks, where do you purchase bonds?
Good question. So it depends on what type of account you have. Okay, IRAs, 401ks, typically there are bond funds, okay? Especially inside your 401k. You're going to see like US bond fund, which is typically a more conservative investment, as I mentioned. Same type of thing on if you have IRAs or just investment accounts, you can purchase those funds just directly like you would your normal stock funds. You also can purchase individual bonds, typically not inside your 401k, but inside those IRAs and investment accounts. You can just do that in those accounts. Anything you'd add to that?
No, I think that's exactly it. We're talking about your location of where you're putting your investments. And I think that's a great place is when you look at your overall asset allocation, asset mix, that's the mix between your stocks, bonds, and cash or short-term reserves. You want to make sure, of course, it works for you in the big picture. And so you can do that in the 401k, IRA, brokerage account. So you have options on where you want to do that. Bonds are there to give you income. That's their point. So you might see folks do it in like their retirement accounts for tax advantages because of that income that's coming in, especially for those who are closer to retirement will tend to have more bonds or bond funds, right? Bond mutual funds, which is like a basket of different types of bonds, short-term, intermediate, long-term. So you get more diversification. I think we're going to talk about diversification quite a bit today.
Yep.
Yeah, because it's important, and I think that definitely will make a big difference for you who need that income when you're getting really close to retirement.
Awesome. We've got a good question here from Pauline. What is the average percentage you recommend contributing? And I assume that's contributing towards retirement.
I would take that way. Now, I don't know if we have the same thought process on this, but I would say general recommendation is obviously what you can, right? First, you want to contribute up to the employer match. And that I feel like we would agree on that. If you can get up to the employer match, you're already helping yourself because you're putting money in and you're getting the help from them. Now, from there, definitely if you can do more, certainly do more. I've heard a statistic that says you want to look at 12 to 15% on average, and that could include the employer match if you want it or contributions or not. You can decide because your budget with everything becoming more expensive, both outside and inside, it feels like. You want to, of course, be mindful of that, but maybe that could be a good guide. What would you say to that?
I totally agree. And I think 12 to 15 is a good general rule of thumb. Now, if you're someone who is maybe a little bit closer to retirement or maybe 10 years out, and in the past you haven't been doing that, 12 to 15%, maybe shoot for closer to 20, right? You may be playing a little bit of catch up, which is totally fine, right? Circumstances change, but I'd say do as much as you can, right? Aim for that 12 to 15%. If you're playing catch up or maybe want to live a little bit different lifestyle in retirement, and want to increase that, I'd say shoot for higher. So really good.
Yeah. Oh, I got a good one for you. We keep hearing about gold and silver. Any suggestions there?
That is a good question. So I think a lot of talk with gold and silver. So those ones aren't necessarily as volatile, right? So you're not going to see these big swings like they are in the market. Now, over time, are they going to perform as well as the market? Not necessarily. Gold and silver are a good option because they are resilient to inflationary measures. Okay, so as inflation rises and as there's lots of uncertainty with the markets, a lot of people will turn to gold and silver. That's typically what I've seen. Anything you'd add to that?
I exactly spot on. When you look at those, I guess, commodities or harder goods, they tend to be consistent in a sense. So you might not see some dramatic
Yeah.
spikes like you would with stocks, bonds, and certainly crypto. So if that's something you're thinking about, it could be a portion outside of your, retirement planning, like your 401k or IRAs. That's something if you want to consider, that's up to you how much you want to go into that portion.
Totally. That's great.
Hmm.
Okay, let's see. Garrett's got a good question. Would you continue to recommend U.S. bonds as foreign countries continue their divestment from the U.S.?
Oh,
That's a good
interesting
question.
question. Yeah. You know, I when we look at general recommendations, both domestic and foreign are good, right? And especially even right now, domestic and foreign, I believe are still good too, because if you want to put it in perspective, right? We're in a domestic market. We understand what's happening in the United States, right? When we go abroad, what that helps us do is, let's say if US is having a bad day, our friends across the pond might hopefully be having a better day, and that could help with the ups and downs and reduce those some of those losses that you're seeing there. So in what we're seeing right now with the potential, right, there has been talks, you mentioned China and the EU, they've been talking about, divesting out or maybe figuring out other tariffs to do outside. Having some foreign and domestic still is there to champion you. Now, one thing I think maybe we can think about is like currency risk, maybe geopolitical risk that happens outside. Across the world, the US currency is like what I would say the foundation or the common
Yeah.
currency, right? So and having bonds in the US could help with that, while you're still having foreign bonds as well. Anything you want to add to that one?
I think that's also very well said.
Yeah.
It brings me back to the topic of diversification, right?
Yeah.
Like you said, if we're having a bad day here in the US, maybe they're having a good day. That way you're exposed kind of on different levels. So up to you at that point and up to your goals. But I think it still could be good exposure in the foreign markets as well. So really good.
Oh, we have a lovely life event. Someone's getting married in a few weeks. First of all, congratulations.
Oh,
That is
exciting.
very exciting. Is there anything that they can set up for couples to invest in together?
Awesome question. So yes, there is actually. It has a couple different names. Okay. A joint brokerage is essentially what it is. Okay. So a joint taxable account. What you can do in that account is it works similar to like your checking account where you can be a co-owner with your spouse, right? And you can put in as much money as you want and take out as much money as you want at any point in time. So it's not necessarily like a retirement account where it's in that account until you're age 59 and a half. But a joint brokerage is a good way to get exposure, put in as much money as you want. It does have tax benefits. Okay. If you hold those investments for more than a year, you get a more favorable tax treatment. So something to keep in mind. But I'd say that's the number one account that I see people use as a married couple.
Agreed. I 100% agree with that. And congratulations. I hope you have a beautiful day. It's also kind of funny because we were talking earlier about budgeting and what to think about budgeting with high inflation. And one of the things I was going to say, no big spending. And here you are getting married. So,
Yeah,
enjoy your big day and then cut back on those expenses right away.
exactly. Budgeting is fun in a marriage. That'll be a good,
Yes.
eye opener for sure, especially
Oh,
after the weddings. So
oh my gosh, yes. Especially
super
if
fun.
one's a spender and one's a saver.
Yep.
That's always a fun time to talk.
Oh yeah. Fun conversation.
Yes, yeah. I did see a question, and I think this goes back to what you were talking about the 500 index, asking what is the difference between S&P 500 index and the Spider S&P ETF trust?
Good question. So in reality, there isn't much of a difference. Okay. The S&P 500 index is just an index. So if you wanted to go out and buy the index, you would have to go out and buy those 500 different companies and their allocations appropriately. Okay. The S&P or the the Spider S&P 500 ETF Trust is essentially an index fund that groups all of those companies together, and you get a little slice of the pie. So rather than you having to go out and buy all those 500 little companies, you can buy it in bulk, okay, and just get a piece of the pie by buying these ETFs or index funds. They have a couple different names, and that's what that ETF Trust is.
I love me a good Costco bulk buy. So
yeah.
that was
And there's
great.
going to be lots of different ones, right? You'll see different names depending on what company is the manager of it, essentially. So Vanguard's going to have their own, Fidelity's going to have their own, Schwab's going to have their own. They're all going to have their own type of funds. Essentially, all of them are tracking the S&P 500 index. So they're going to perform very similarly. I would just say look at the cost of them. Okay, those expense ratios is going to be the number one thing you want to look at. Some may be higher than others, but I'd say they're essentially the same thing.
Absolutely. One of our audience members said PB&J sandwiches and ramen noodles every meal after that wedding. So
yes.
Hopefully you can eat a little bit more healthier than that, but keep that in mind. There was another question, and I really like this question. It says, what exactly is a CD? And would you suggest investing in those and a 401k, maybe like a 6% in each one?
That's a good question. So a CD stands for Certificate of Deposit. Typically, when you go and purchase a CD, okay, that's going to be at your bank or, potentially in an investment firm, right? Those funds or those accounts are typically locked up for a certain period of time, anywhere from 6 months, some up to 18 months, maybe even longer than that. And the benefit of a CD is you get a locked-in rate. Okay, so let's say you go to your bank, you get a CD for 4.5% for a year. Okay, you're going to get that interest rate of 4.5% for that full year. The downside to CDs is, like I did say, they are locked up. So typically, you can always get out of them. You may have to pay some fees of that sort, but typically for your emergency fund or investments that you want more liquid, those are a good option in something like a high yield savings account. Okay, now those yields or those rates are going to fluctuate as interest rates fluctuate. So right now we know interest rates are high. They may stay high with where inflation goes. If those stay high, those rates on CDs and your high yield savings accounts are going to look still pretty good. As rates come down, you're going to see those rates in the CDs and the high yields come down. I'd say that's another topic for diversification, right? If you have some in CDs, some in your high yield savings account, and then more in your 401k, that kind of fills all of your buckets, right? You've got your short-term bucket, maybe your midterm bucket in about a year or so, and then your long-term bucket, such as retirement. So it's a good way to fill those different buckets and diversify amongst different asset classes and funds. So
I like that answer very much. Another one. Where do I start with investing in stocks? Where or who do I go to? From Nadia.
Really good question, Nadia. And that's awesome that you're wanting to kickstart that, right? That's the first step, is just starting. For a lot of people, I'd say going to those large financial institutions first. Okay, so if you've heard of Fidelity or Vanguard or Charles Schwab, those are some of the big names that people will go to start investing. Okay, this is outside of your 401k or IRAs. Okay, so outside of those retirement accounts. If you have a retirement account at work, that's where I would start. Okay, start contributing to your 401k, get the match, maybe increase a little bit. But if you have goals outside of retirement and want to invest maybe a little bit more, like I said, go to those financial institutions. They're very intuitive. Their websites are super user friendly, and it costs $0 to open an account. So really good option to start there. They'll also give you lots of lists of different funds that you can invest in, because that's one thing. You open the account, and then the question is, now what do I invest in? So luckily, a lot of those institutions provide good educational services where you can do more research on your options. So that's where I would start.
Yeah.
Anything you add there?
Yeah. Just to tag on to that, there was a question which I'll answer, give you a break from all your yapping. There was a question that came up just asking you to repeat what you said about accounts to add with your spouse. Now, with that one, it was what was the name of that account that you mentioned with your spouse? It was a joint brokerage account, Tom asked. That is correct, a joint brokerage account. And where can you open an account like that? Would it be like a bank, your credit union, or would you go to one of those brokerage firms like a Vanguard or Fidelity? The account is a joint brokerage account. Now, where do you want to do this? A Vanguard or a Fidelity or a Schwab is common because those are brokerage firms, right? That you can open those accounts and then you got a slew of things that you can invest in, right? CDs, stocks, bonds, ETFs, mutual funds. Now, your banks might give you the option to open a brokerage account. They may have like a brokerage firm inside there. For example, like Wells Fargo might have Wells Fargo advisors or like
Yep.
private bank or something like that, where you can look at your bank credit unions. I'd say it most likely not, but maybe you might have a very unique credit union, but they would allow you to open those joint accounts, whether online, over the phone, either or, and you can open them together and then invest in various things that you want to go into.
Great answer. I've got a question here from Tim. He asked, high yield savings accounts and reporting interest on taxes. I had to offset with investing cash from savings accounts to traditional IRA and avoid paying taxes. Then when I retire, I have to pay taxes again on the traditional IRA investments. Thoughts on this runaround, good or bad? So just simply to answer your questions a little bit, Tim, yes, any interest or dividends that are earned on your high yield savings accounts or your taxable accounts, you will have to pay in the year that those are earned. Okay. And you'll have to pay ordinary income taxes on it. Okay. So that's just something, if you have a lot of money in a high yield savings account and you're getting thousands of dollars a year in interest, you will have to pay ordinary income tax rates on that. And what Tim's saying he does is he takes that and he invests it into a traditional IRA and gets a tax break. That's an option. I would say it's different for everyone's situation. So to speak onto yours, I'd have to know your entire situation, but that's one way to reduce your taxes. And then of course you have to pay tax on that interest. So I'd say just talk to your tax advisor or your financial advisor to make sure that that's a good strategy for you. But based on, the simplicity of it makes sense.
Yeah, part of that question, then he mentioned I have to pay taxes again on the traditional IRA investment. And you're right, right? When you invest now in the traditional IRA and it makes money, as the money is growing in there, you don't have to pay taxes. But when you start making withdrawals from those IRAs, that traditional IRA, you then have to pay taxes on the money that comes out. It's seen as ordinary income. So that will be just added back to income on your account. So if the concern is being worried about taxes, like I agree with Brielle, you definitely want to talk to a financial advisor, tax advisor, to see maybe how you can reduce some of those taxes if that's a concern for you.
Exactly. Yeah, when it comes to traditional IRAs or Roth IRAs and different tax liabilities, I always say that regardless of the timing, the IRS is going to get their taxes, right? Whether that's now, so you either pay the tax on that interest now, or it's later when you withdraw in retirement. So regardless, there are different tax strategies to reduce that liability or potentially pick the timing of your taxes. But the reality is it's going to come either now or later.
So, and Sabrina was asking, do you have to pay taxes on withdrawals from Roth IRAs?
You do not. Nope. No taxes on withdrawals from Roth IRAs because you pay the tax when it goes in. So let's say you make a max contribution of this year of $7,000 into your Roth IRA. You'll pay tax on that $7,000 contribution in 2025. And then let's say 20 years down the road, that $7,000 grows to $50,000 for simple numbers, and you withdraw it to live off of in retirement, you don't pay any more taxes on it.
That's very, I like that. I think we're heading into taxes because I'm seeing questions on taxes right now. And Dennis made a comment saying, where's the link to make you two my advisors so I can make less mistakes for the future? I'd say Brielle is the smarter one of the two of us, and she's the advisor. So I would go her, Dennis. But thanks Thanks for thinking of me that way. Um, there was a question asking, can you borrow from your 401k without the penalty? And the answer is yeah. You can take a loan from your 401k rather than a withdrawal. With the loan, just like it sounds, it's a loan. You would pull out a certain amount of money that you will eventually pay back. Now, there's interest on the loan. Now, the nice thing with it being from your 401k, you're sort of paying yourself back with interest, if you want to look at it that way. And that will just go back until you finish paying off the loan. Now, things to keep in mind: ask your 401k if they provide loans, if there are any fees for the loans, what's the interest for that. That you would be paying back into the 401k and the amount of time you have to do so. Because the other side of it is, if let's say you don't meet the time frame or you were to leave the company, it turns into a withdrawal. And once that happens, that's when we think about penalties and taxes. The most common penalty is if you're below 59 and a half and you pull and it's now a withdrawal, you have an extra early withdrawal penalty of 10% plus taxes. So that amount is added back to your income for the year, which you already had to take money out in the first place from your 401k. Now you have to pay more in taxes. That's no fun. So figure out what that could look like for a loan compared to a withdrawal and how that could work in your favor.
Awesome. I've got a good one here from Debbie. She asks, can you pay tax before you withdraw your money? Go ahead. Or do you want to answer that one?
So I'll start. Feel free to correct anything I say. So if you're taking a distribution from your 401k, you potentially could have the option to withhold federal taxes from your 401k. I believe the amount is 20% is the standard, if I'm correct, from the 401k.
Yeah, I think it depends on what company it's at and things of that sort. But yes, yeah.
Right. And so what you're doing, you're sort of paying taxes ahead of time, right? When you make that withdrawal, you're sending that withholding early before then you pay taxes tax time. And that money would go at that point and you'd pay taxes there. If it was an IRA, right? With IRAs, your flexibility, you can withhold a certain amount or you don't have to. Now, for IRAs, depending on the institution and depending on the state, they may also let you do state withholding as well. So you get that additional option if you want to pay ahead of time. Anything you want to add to that?
No, I think that's exactly perfectly said. You can withhold if you want. If you're someone who's a saver and you can kind of budget for those taxes in the future, right, at the beginning of the year, then you don't necessarily have to withhold that, because you may withhold too much, right? Because it's kind of a guess. You're not entirely sure what your taxes are going to be at the end of the year when you withdraw from those retirement accounts, but something to keep in mind.
Mm-hmm. Next one, continuing our tax chat. I like this, market volatility and taxes.
Yeah.
Do you think it is a good idea to change current 401k traditional contributions or pre-tax contributions to Roth contributions to avoid the taxes on larger anticipated value of those contributions? I'm assuming later on, from Brenda.
Awesome. Brenda, I like this question a lot. So really, the short answer is it depends. Okay, it depends on where your current tax situation is and where you think tax rates will be in the future. So traditional contributions are great for those people who may be in their higher income earning years. Okay, so you're making a lot of money, you want to reduce your current year tax liability. In that case, you make your contribution to your 401k and you get a deduction on your taxes. On the flip side, if you're someone who is comfortable with where you're at with your taxes, you may be in a lower tax bracket or hope to make more money in the future, Roth is a fantastic option. Even for those high income earners, I'm still a fan of Roth because your tax rates now. We don't really necessarily know where they'll be in the future. They could go up, they could go down. We don't know what they'll look like in 10, 20, 30 years when people are in retirement, right? The Roth, you pay on what goes in. Okay, so if you make a $20,000 contribution to your 401k this year, you're going to pay that tax on that contribution. And then whatever it grows to, whatever fluctuation or whatever happens over the next 10, 20 years, you don't have to worry about that. So I'd say the short answer is it depends. But I think Roth or traditional are really good options. They're both tax advantageous. Okay, it's either you get the tax benefit now or you get it later. So Um,
Yeah, and
yeah.
to add to that, even if you end up, let's say, doing both, right? You've done pre-tax for a while, and let's say you switch to Roth or you start doing both. What you're doing is now you're diversifying your tax situation. We talked about diversification with your investments. Now you're doing it with taxes. So in by the time you get to retirement, and let's say you are one of those high income earners who said, you know what, Brielle's right, let's put some money in Roth. Now in retirement you'll have these two buckets, and based on your needs of what you need money for, you can pick which bucket you're pulling for. So for example, you might take for your everyday living expenses from pre-tax because you know that's going to be taxed in retirement. And then let's say you want to treat the family out to a trip to Disney or to a national park. You may pull a little bit more from the Roth because you know you don't have to pay taxes on that portion and go that way. So you're giving yourself diversification, flexibility to use your money that will work best for your retirement.
That's awesome. One other thing I wanted to touch on when it comes to Roth. So the difference, we kind of talked about the differences there, the different benefits. Another awesome benefit to the Roth is you don't have what's called required minimum distributions. Okay. Like I said, the IRS is going to get their taxes either now or later. On those traditional contributions, depending on your age, okay, anywhere between 70 to 75, you're going to have what's called a required minimum distribution. Okay, so in those pre-tax accounts or those traditional accounts, the IRS is going to say, okay, you've now hit this age and you haven't taken out money, so we're going to require you take out $100,000 this year. So regardless, you're going to have to take out money and pay those tax on it. The benefit to the Roth account is there is no required minimum distributions. You could put money in now and never take it out until your age 100 and never have to worry about taxes, right? So that's another benefit to the Roth is no required minimum distributions. And the IRS won't come calling for any sort of their taxes because you've already paid them. So another benefit.
That's a very good fit because you don't have to take out more money if you don't need to in retirement. And with required minimum distributions, you have to, right? So you don't incur that penalty. There was a question asked earlier asking, what do we think about the company like Facet, I believe is how it said. And from what I know of it, it's an online like financial advisor. So sort of like a robo advisor. And I guess like I'll start, and feel free, Brielle, to go from there. Now, I would say with those online robo advisors, right, they're pretty standard, right, in the sense that you pick a custom plan, right? They may have here's option A, option B, option C, based on your answers to your questions when you'd like to retire. Now, I would feel as humans, we're maybe a little bit more nuanced than that. There's some complexity to us as people, and things happen. And maybe the online service can adjust with that. But I would say, as someone who likes talking to people, if I had someone like Brielle that I could call and be like, listen, I decided to get married next week. How's the money looking? It might be dramatic, but I think the idea is, of course, what's most comfortable to you and what you would like compared to speaking to someone instead of not speaking to someone. The idea is, there's a service doing it for you and how that could work in your favor. Anything you want to add to that?
No, I think that's very well said. Yeah, there's benefits to both, right? If your situation's simple and you'd rather just pay for a little bit of investment piece, then absolutely you can go with the robo advisor. The benefit of a face-to-face financial advisor is you get more of the financial planning, right? So as your situation gets complicated and as things change, right? Marriage, kids, all these things that happen, retirement, it's better to have a plan. And that's really where technology and AI and all these things can't necessarily do for you because it's more personalized. So I think totally depends on your situation. Both are great options.
For those who have kids, there was a question asking, is it now a good time to open a custodial Roth for my teenagers?
Great question. I think absolutely that is a great time for, to open up accounts for your kids and have them start funding. One thing about Roths, I believe for the custodial Roth, I think the child still has to have some sort of earned income. Okay. So whether that's babysitting or maybe they own a small business in order to contribute to those accounts. So just make sure you're following those those tax rules and those different limits, even for the teenager accounts. But absolutely.
Agreed with that. But yeah, if you can get them early off with investing, the younger they are, making even giving them more time on their side for their future, definitely a great thing to do. And maybe you should, a little for mowing the lawn or babysitting, or
Yeah.
I don't know, taking out the trash or for something, and then slowly put that maybe, and that could start building them up. Or if they have a part-time job in high school, then you can start that indeed, for sure. There was another one
Totally.
asking, if I had a prior 401k from a previous job, and then now I have a new 401k at my current job, should I then combine them or keep those separate?
Great question. So this one, another type of the short answer is it depends, right? If you're someone who likes consolidation, you don't like remembering multiple logins, and you just want it all in one place, absolutely, you can roll it over. One thing that I would always look at is see what fees you're paying on both accounts. Okay, the fees and potentially the investment options. You're going to have different investment options at the different 401k institutions. So take a look at those, see which one's more applicable to your situation and your goals, make that move. And like we talked about earlier, right now with the market being super volatile, if you do make that transfer, you may potentially be missing out on a couple days in the market. And while we're seeing, these 3-4% swings each day, it may be good to just wait it out. But at this point, totally up to you if you're someone who just wants it simple and consolidated.
That's very, very true. Yeah. Especially if you're not, with the way everything has a username and password nowadays, it just feels like we have so much number that, and then the fees,
Yeah.
good points to point out. Now, there was one question asking, and I'll take this one for a moment, where it's like, can you withdraw or borrow your Roth contribution and leave the invested amount without getting penalized? Now, to sort of differentiate, when you borrow, regardless if it's pre-tax or Roth, because you're taking out a loan, you're not going to incur any penalties because it's a loan and you're going to pay it back. If you were to take a withdrawal from your contributions of Roth, since you already paid taxes on those ahead of time, when you do withdraw your Roth contributions, you won't pay any taxes at that end. Now, can you separate those out? That it depends. Some 401k companies will either do what's called, they'll prorate the amount and it doesn't matter. They'll take contributions and earnings. So then you might incur a penalty, right? Because you're pulling from some of the earnings. Some will let you do the selection of taking just the Roth contributions or just leaving the earnings there. So you want to check with your 401k. Now, if it's an IRA, I do believe you have a bit more flexibility with pulling the money out. Brielle, feel free to correct me from that there's a little bit more flexibility with the IRA than the 401k.
Yep. The short answer to the IRA is you can pull out your contributions anytime, tax or penalty free. So that is one of the benefits of the Roth as well. You do miss out on those gains though in the future. So one thing to keep in mind if you are pulling out early, but something to keep in mind. We've got a good question here for you, Diana. Julie just asked, I am nearing retirement. I may not have the time for my investments to recoup the volatile market. What do you suggest? Should I move it to prevent a large loss at this time? This is kind of about those short-term goals that we were talking about.
Yeah, it is. And first of all, Julie, that's hard. Anyone right now who has, let's say, maybe 5 or less years to retirement, this is something that's top of mind because you probably expected a certain number and now you're not seeing that number and you're seeing a huge drop in that. And then naturally, you are worried and panicked. So what should you do? As you're that much closer to retirement, you want to think of retirement in 2 ways. First, you're going to start needing money. And you have on when do you start needing that money? Because your mix of investments are going to have stocks. Most likely, a good portion of them should be in bonds if you're a couple of years out to your retirement. retirement. So those bonds are going to be there to help you take your income. Now, the second part is in your retirement, the idea, the hope is you still have 10, 15, 20 to enjoy your retirement. So even though it might feel like today, I don't have time to write this because I'm retiring tomorrow, you're not using all your retirement tomorrow, even if you retire tomorrow. You're only going to start slowly using it over time. So you can still leave some of that money in stocks. So let's say by the time you retire, you're 30% stock, 70% bonds, as an example. You still won't go through all 70% of your bonds in year 1 or 2. You're slowly going to be taking money out while the rest still keeps investing and accumulating. And hopefully, as the market comes down, or if we figure out what's going to go on, that in those years to come, you can recoup some of those losses. Anything, Brielle, you want to add to that?
No, I think that's very, very well said. Honestly,
Mhm.
nothing I'd add there. One thing
Yeah.
that I guess I could add is while you are still a year or so, or maybe a couple years out from retirement, we don't know how long this dip is going to be, right? It could be a month, it could be a year, it could be a couple years. One thing I would suggest is maybe stocking away a little bit more for your short-term needs. So make sure you have that emergency fund. And then maybe you increase your exposure to bonds or just on your contributions, right? Rather than shifting everything that's in your portfolio right now, focus on your contributions for the last few years, whether that's more cash, treasuries, those more conservative investments. But I think Diana hit the nail on the head there.
Mhm.
Let's see. We've got a question. Oh, go ahead.
No, feel free. Feel free.
Okay. I've got a question from Tomica. They asked, what exactly is Acorns, and do you think it's an appropriate way of investing?
Oh, so Acorns, I believe Acorns is that app where you can like it takes your pennies, so it rounds up your money
That's
whenever you
yeah.
spend money somewhere, right? And then it rounds it up, and that roundup, let's say it's 50 cents to get you to the whole dollar, it invests that portion. And the question is that an appropriate way to invest? Maybe. It depends, right?
Yeah.
One, you're working for a company, you have your 401k. So that's step one. One of your biggest ways for investing in retirement is your 401k. Now, if you wanted to do a little bit more, and Acorns is an easy way for you then to get in the habit of investing. I guess it doesn't hurt, right? Because you're putting money for the future. And I think if I know correctly, they're invested in, I think, index funds, maybe ETFs, which are still a combination or a basket of investments that trade throughout the day lock. That's probably why you can continue putting your money into roundup dollars. So you have that benefit. So it's another way if it gives you a good habit of investing and learning about investing, why that would be a bad idea. What do you think?
Yeah, I think along those lines, what that app intuitively does, that it helps you do what's called dollar cost averaging. Okay.
Mm-hmm.
So what dollar cost averaging is it's putting in a certain amount of money each month, each week, whatever you decide. That way you're getting in at different points in the market. So this is a good way that I think for a lot of clients is a good way to help them just get on a system, right? Rather than just bulk funding at the end of the year or bulk funding at the beginning of the year. Still a really good option, but similar to your 401k, you're putting in a certain amount each paycheck, so every 2 weeks. That way you're getting in when the market's low, when the market's high, when it's taking different dips, and taking advantage of that volatility. So if that Acorns does that as well, I mean, I think that's a good way to just get exposure, but it really depends on your goals and kind of the system that you like the best.
Mm-hmm. Another one question asked, why would there, from Janine, why would there be why would there be different investment options based on a previous employer versus your present employer?
Good question.
I would say
so this,
that is a good question.
Yeah, go ahead.
Go ahead. Look at us.
Well, I'll just briefly touch on it and then.
Yeah. Yes.
Sorry, we're cutting over each other. So what I would say is it depends on the institution and typically the company that you work for. So let's say you move from an extremely large corporation with tens of thousands of employees. What those corporations can do is they can go to these 401k companies and say, hey, we've got tons of employees, tons of funds that are going to be in this 401k. We want beneficial pricing. And they're able to negotiate prices and investment options for their employees. Okay. On the flip side, if you're part of a smaller company, they just may not have as many options given their size and just the fee structure that these 401k companies have. That's my simple answer. Diana, what would you add?
That's a good point, right? Depending on what firm you're working for and what they have, each company has what's called an investment committee, and they sit down and they'll review what they can invest in for employees, right? And make that decision. So that's why you can see differences, the size of the company on what's being offered and the record keeper, the person who holds a 401k, what they're offering. That's why you might see a difference in the different type of mutual funds that you can actually go and invest in. So look into those.
Awesome. A question here that I can actually take is, do you suggest interviewing 2 or 3 certified financial planners, and what questions should I ask? So, as a certified financial planner myself, I can give you some of those answers. I think it's great to interview around and, maybe talk to a couple to see, first off, what are their investment strategies? Okay, that's a portion that they can help out with. Of course, their planning piece. So, are they giving, more tax advice? Are they helping with your estate plan? What different areas do they touch outside of investing? That's a huge part, right? They're certified financial planners. They should come to you with a plan and a strategy that works for your goals. On top of that, certified financial planners have a fiduciary responsibility. Okay, so they should be acting in your best interest and putting that at the forefront of their minds. So make sure that that's top priority. And then, of course, just if there's someone that you work well with, if your interests align and you guys sit on the same side of the table, right? And your plan, your investment strategy, and things of that sort are in alignment, then I'd say see if it's a good fit. But I definitely think it's a good idea to maybe interview a couple and see where things go from there.
Mm-hmm. I also even rapport, some of the softer side of things, right? You want to you're building a relationship, right? So for me, I know on the times like now when the market is going where most of us might panic, will sell things off, I need my financial advisor to talk to me in a way that I'm like, okay, I hear you, right? Because a financial advisor could be very technical, hear the numbers, but even though I'm in finance and I know the numbers, I can't have you speak to me like that. I need you to tell me, hold my hand.
Yep.
Tell me it's okay. We'll make it through, So that also comes into play because if we're building the relationship for the long term, the hope is, right, ongoing management, you want to have a connection where you feel good working with that person.
Awesome. Very well said. Yeah, and I think another good thing is if this financial advisor or your certified financial planner is making touch points periodically throughout the year, especially in these down markets. For me, it's a perfect time to reach out to clients and let's talk about your situation. What are we doing with your investment strategy? How does this affect your financial plan? Right? So if your planner or advisor is ghosting you during these times, that's definitely something you want to avoid and maybe a red flag, but something to keep in mind.
Yeah, absolutely. That's a very good point. Now we're coming right up on time. I just realized, check the time. So take one more question and I'll pose it to you, Brielle. Cindy asked, I set up a Roth IRA last year and my goal is to max out my contributions at the start of each year so it can work for me throughout the year. Do these contributions automatically become part of my initial investment option, or can I choose to invest my yearly contributions in different options within my Roth IRA?
Good question. So once you contribute the money, the next step is to pick the investment option. So if I'm understanding this correctly, you can either set up the automatic contribution, but from there you can set up an automatic investment. Okay, so the contribution is step 1, the investment is step 2. So from there you can pick your investment options and have that be reoccurring depending on if the system lets you do it. But typically you may have to go in each month or each year to invest those funds, if that makes sense.
Yeah, that made sense to me. You decide if you want a dollar cost average like we talked about earlier once you pick your investments, or like you said, put it in and let it work for you from there. But folks, with that,
Perfect.
we want to say thank you so much for joining us. Thank you for the great participation that we had today, and all the questions you guys had. Remember, WealthSense is here for you. It's a resource you're available to use. Utilize it. Get the resources that you need. Also, there's a help desk line that you can email if you wanted further help, and we'll get you connected with a financial advisor or financial coach to help you with what you need. And with that, take care, everyone.
Awesome. Thanks, everyone.